Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Rising to a record. Asian stocks touch historic highs after weak US retail sales reinforce bets on Fed rate cuts. Traders closely watching for payroll revisions due later today. Back on track. EU lawmakers move closer to approving a US trade deal after it was put on pause over President Trump's Greenland threats. Plus, a bumper day for earnings in Europe, with numbers due from Heineken, ABN AMRO and Commerzbank. We'll have interviews with the German lender's CEO later this hour. Well, a very good morning. Welcome to Wednesday, which, weirdly, is Jobs Day. We already got those unexpectedly weak retail sales numbers yesterday, and I would show you the impact on treasuries, but they're not trading in cash right now because Japan is on holiday. What I can show you is the impact on gold. Higher this morning, past $5,000 an ounce, on this expectation, because of those numbers, that we'll see more Fed cuts, maybe 3, not just 2. We've also got the Bloomberg Dollar Spot Index weaker as a result. You can also see in the futures picture stocks looking to be higher in the US session today, already at a record in the Asian session as we look ahead to that US jobs report. So let's look at the risk events on the docket for today. The highlight of the week, of course, is that jobs report coming out later. Economists expecting 65k to be the payrolls number, the whisper number 36k. So can this add to those expectations of Fed cuts? We'll get commentary on it from Mickey Bowman of the Fed at 3:15 p.m. London time. But we also today need to keep an eye on the oil market. We've got the OPEC report coming. We've already had signs of swelling inventories from the American petroleum industry report. But it seems that for the moment, traders are more focused on the geopolitics, the rising tensions between Iran and the US. So much to bring you today. Let's set you up for the day ahead. We begin with earnings just breaking across the terminal from Commerzbank. Already we got some of these numbers yesterday. Full-year earnings beating estimates. They're planning to start a €540 million share buyback. And what we're seeing this morning is they're confirming their financial targets for 2028. They see their 2026 CET1 ratio above 14%, although the estimate was for 14.5%. Net interest income for the fourth quarter coming in at €2.05 billion, so almost bang in line, just beating the estimate of €2.04 billion. And all of this on top of the news about the chief risk officer, Bernd Spalt, to step down as well. But clearly the buyback part of CEO Bettina Orlopp's defence against UniCredit's unsolicited approach, and we'll be speaking to her herself. Commerzbank CEO Bettina Orlopp joining us at 6:30 a.m. London time. Now, switching over to earnings out of Holland, we have ABN AMRO reporting as well. They have fourth quarter profit coming in at €410 million. The estimate was for €497 million. So a miss there. Net interest income €1.67 billion. An ever so slight beat on the estimate there. The operating income is €2.26 billion. Just shy of the estimate of €2.29 billion. But staying in the Netherlands, we also have earnings from Heineken to bring you full-year organic beer volumes down 1.2%. The estimate was for it to fall 2.48%, so not as bad as predicted, but really the focus will be on the outlook. It was expected to stay tough in Europe and the Americas, and we'll find out more about that from the Heineken CEO, Dolf van den Brink, at 7:30 a.m. London time, in his final earnings interview, by the way, before stepping down. Well, staying in Europe, turning away from earnings, the European Parliament's moving closer to approving a trade deal with the US after senior lawmakers agreed to make some changes ahead of a vote planned this month. For more, Bloomberg's chief Europe correspondent Oliver Crook joins me now. He's with us here in London. Ollie, just talk us through what these changes are and really what it's going to mean for both sides.
Yeah, so Lizzie, this is a story that began in April on Liberation Day, a day that we'll never forget, with the big board with all the tariff results, and then the negotiations ensued, and then it went over to Turnberry where you were covering it, and that trade deal that was struck between the EU and the United States. This was supposed to be officially ratified earlier this year, and of course that was all put on hold after the antics around Greenland and basically the Europeans saying, how on earth can we sign a trade deal with the United States when you're threatening more tariffs? Now they've decided at the highest level they're ready to move forward with this, that they're ready to to ratify the deal. There was some misgivings about it with some of the parliamentary groups within Europe. There wasn't a clear idea that this was necessarily going to move forward. They are now going to do so, but with some caveats. And the caveats are that if basically by March of 2028 there is not an agreement on steel and aluminum, because remember, that is not covered by the 15% tariff, that is still at 50%. If they don't get a deal on that within the next 6 months, they have the option of basically moving back on this deal and renegotiating with the United States. Now, 2028 is very far from today, so it's sort of an awkward timing in terms of if you don't get the deal within the next 6 months, you're really going to renegotiate that in a year and a half. Plus, it's an election year in the United States. Is that really something you can do? But that's basically where we stand with the Europeans. So we will get officially this trade deal move forward with the Europeans and the United States. Again, they still would like to see it come down on steel and aluminum.
Now, you've been speaking to the European Council President Antonio Costa. We're going to play it later on, but just give us a flavour of the highlights. Yeah, so what's really interesting is for Costa last year, it was all about defence. And basically what he says is what we achieved at the European level in a few months, what we've been trying to achieve in decades. So be it spending, defence, NATO, hitting those 5% targets and really getting that spending higher, those trade deals with Mercosur and India, things that have been in the making for 20 years, they managed to get over the line. Now the focus this year is going to be on that very sort of big word, competitiveness, getting competitiveness up in Europe. That is about bringing down trade barriers within the EU, about potentially getting joint debt. Macron yesterday was talking about the Greenland moment. Is this the moment where we can get joint debt over? And that is sort of the main focus. The other thing he's also concerned with is Ukraine. Obviously, we're in the potentially final stages of a peace agreement, or at least, getting sort of momentum towards that. What is the EU's role? It's all about accession, bringing the Ukrainians into the European Union. There's been a very big debate about how exactly to do that. Have a listen to what he had to say.
European accession from Ukraine is a key element of a future peace agreement. Then I hope that Russia finally decided to be open and engage seriously in the peace negotiation process. And it will accelerate all these debates on enlargement, not only to Ukraine, also to Moldova, to the Western Balkans. And the enlargement is now the most important geopolitical investment that Europe can do. We underscore always that we need, at the same time that we are negotiating the enlargement, to make our internal reforms on institutions, on budget, on policies, in order to ensure that the upcoming enlargement will be so successful as the previous ones.
That was the European Council President Antonio Costa speaking to Bloomberg's Chief Europe correspondent Oliver Crook, and we'll bring you more of that interview later on at this hour. But first, I want to turn back to markets because we've got Asian equities hitting a fresh record this morning. We've already had the US retail sales numbers yesterday. We're looking ahead to the jobs report today. Let's get a check on Asian markets with Winnie Xu in Hong Kong. Winnie.
Yeah, morning, Lizzie. It is that combination between the strength in the technology shares and also the weakness in the dollar. Now, we know that Asian stocks and the dollar usually move in opposite directions, but this time around, that inverse correlation is actually at its strongest since April. And also that weakness in the dollar pushing the Japanese yen higher, actually strengthening 1% here through that 153 level against the dollar. And when it comes to technology shares, you're looking at benchmarks in South Korea and Taiwan, both up more than 1%. And in fact, the momentum in Taiwanese stocks really strong on the last day of trading ahead of that very long Lunar New Year holiday. We are only resuming trading on the very last week of February. Now flip the board and take a deeper dive into the chip stocks, because interestingly, we are looking at SK Hynix falling almost 2% after that local report saying that China's biggest memory chip maker, CXMT, is allocating part of its DRAM capacity to HBM3 chips for AI, and that means more competition for the likes of SK Hynix and Samsung. However, for Samsung here, actually reversing earlier losses after its CTO saying that its HBM4 chips is actually top of the industry. When it comes to the other side of the memory crunch story, we are seeing that SMIC here down about 3%, leading losses in Hong Kong, and that's coming after earnings missing estimate, with the company citing that the PC and smartphone makers are actually cutting orders due to that memory crunch. Back to you, Lizzie.
Winnie, thank you. That's Winnie Su in Hong Kong. Well, let's get to that data highlight of the day and the week. Of course, it is the US payrolls report for January. And really, what is it going to mean for the Fed's rate path ahead? It's expected that the update due later today is going to reveal a notable markdown to the payrolls growth in the year to March 2026. Let's get analysis now with Bloomberg Market Live cross-asset strategist Mark Cranfield. Mark, good morning. Just walk us through how this data is likely to affect treasuries and stocks. As Winnie says, we can't look at treasuries right now, but we saw big moves off the back of the retail sales numbers yesterday.
Yeah, good morning. As you were saying earlier, we already had a drop in yields overnight off of weak data there. So that gives us a taste of what to expect. But it didn't do any harm to the US equity market, really. And we've seen today markets are doing pretty well across Asia, as Winnie was saying there. There's still a pretty good mood there. We are getting close to a point where investors are going to have to decide whether bad news is good for assets or bad news is just bad. And that's really the equity market in a nutshell. So the fact that people are now thinking we could have 3 rather than 2 interest rate cuts from the Federal Reserve for the moment is letting people think it's a generally a good thing for markets broadly, for treasuries, for equities. It's not obviously so good for the US dollar. But if we get really weak employment data on the back of that as well, that could tip the balance where people think really the US economy is not performing anything like people were looking at just a few months ago. People will start revising down their GDP outlook and generally they'll be dialing back. So treasuries could continue to do pretty well, but we certainly could reach the point where more economic weakness is no longer seen as positive for the equity market. That could start to happen if we get a few more pieces of poor data. US employment is certainly one of them, but also as we look ahead into the coming weeks, we've already seen people starting to question whether the confidence factors in the US are already deteriorating. And once we get a couple of those, people will have to look ahead and say, well, the first quarter performance might not be that hot in the US. And that's where you could get a divergence between equities and treasuries. We're not there yet, but that is something that will be top of the mind for investors as they dissect the data today.
Mark, thanks for the analysis and the preview. That's Mark Cranfield, Bloomberg Market Live executive, cross-asset strategist. Mark Cranfield there. Well, still to come on the programme, we're going to be speaking to Bettina Orlopp, the CEO of Commerzbank, after the German bank reported full-year earnings that beat estimates. But first off, we're going to be speaking to Rufaro Chiriseri, who is UK and Europe head of fixed income over at RBC Wealth Management. We'll dive into the markets and get her view on Alphabet's rare 100-year bond. That next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:15 a.m. here in London. Now, investors will be looking for signs that the Fed will have scope to lower interest rates when that US jobs data arrives later on today. The Bureau of Labour Statistics is likely to sharply revise down jobs growth. Well, joining me now for analysis is Rufaro Chiriseri, who is UK and Europe head of fixed income for RBC Wealth Management. Good morning, Rufaro. Nice to see you. So I want to start with the retail sales data yesterday because it was unexpectedly weak. Yields down off the back, as we were discussing with Mark Cranfield. Are you already seeing 3 Fed cuts this year, even before we get to the jobs data?
Well, our economists actually have the view that they're not expecting any rate cuts this year. And this was really off the back of expecting that there was stabilization in the jobs market, but then also ultimately that we're going to see that peak in that sort of tariff-induced inflation in sort of the second quarters of this year. And so our view had sort of really been to push out those rate cuts coming through from the Fed. That being said, we're certainly seeing that, the market is really poised for that labour market data to come in weaker. And we expect that we're going to continue trading in this 4% to 4.20 range for treasuries. So if markets are disappointed with the data, we're likely to trade lower in that range. And of course, that neutral rate will continue to be pushed down as well. So we've been in that 3 to 3.20 range. So ultimately, we think the markets will continue to be in this range trade moment until we sort of get better clarity on the data and also what the Fed will potentially do over the next few months.
OK, well, while we wait for that data, let's turn our focus to the UK, shall we? Because you've also said that there's room for gilts to outperform. Where's safe along the curve?
So typically what we've been doing with a lot of our solutions is we've been avoiding that long end of the curve because we really don't feel that there's enough compensation for that sort of risk that you're taking at that ultra long end of the curve. We think the sweet spot is sort of that belly of the curve where you are getting a steeper curve. So you're getting a pretty attractive return over a 1-year period. Of course, gilts are still quite sensitive to what happens to global markets in terms of global bonds, but then also ultimately any sort of risk premium can also start to be built into gilts. So we still see that there are periods where we might stretch beyond our sort of target ranges, and those are good opportunities to add to gilts. But then equally at the same time, we're still quite cautious of perhaps this dynamic where we're expecting that the BOE will ease to 3% at the end of this year. But of course, that wage inflation is really what's going to support that sort of view. And so we continue to expect that to trend lower and ultimately pull inflation lower. And with slack in the labour market as well, and we expect growth to be somewhat tepid, we think that environment is supportive for gilts and also for BOE easing as well.
Well, let's talk about the politics here, Rufaro. We've got to talk about the elephant in the room. We had commentary from Andy Burnham, the Mayor of Greater Manchester, yesterday, saying that we got his comments on the bond market all wrong. He isn't saying that we shouldn't mind the bond market. We just don't need to be in hock to the bond market. Is there anyone who would be a more market-friendly leader of the Labour Party, a more market-friendly Prime Minister than Keir Starmer?
Well, I can't get into sort of speculating in terms of who the potential leader could be. But I think ultimately what the bond market is looking for political stability and also looking for fiscal discipline. And so currently, when we had that budget in November, we did sort of get that, and gilts were pretty comfortable with what the budget was announced. We have that increased headroom. We also have the DMO that is skewing issuance towards the shorter end of the curve. So that's all proving to be quite supportive for gilts at the moment. But of course, those are the key risks that bond markets will be looking at.
Well, I'm sure perhaps they'll be taking note of those comments, Rufaro, all these many candidates who might like to replace Keir Starmer. Let's turn away from the UK and to the ECB, because it, unlike the Bank of England, doesn't look like it's going to do much for a long, long time. Is there a level of euro strength that could provoke a bit more activity?
I think it's quite interesting to sort of bring up the currency aspect, because during the last ECB meeting, this was something that was addressed during the press conference quite repeatedly. And Lagarde sort of pushed back on that, sort of stating that the current forecast that the ECB has taken into account that euro strength since the March period through to the end of the year. And so the ECB has almost baked that into their forecast. But we think ultimately, if the euro continues to strengthen, it will exert pressure on that disinflationary process. And if the ECB continues to see that inflation continue to trend lower and further away from target, it could perhaps maybe sort of raise some eyebrows and potentially sort of bring that sort of potential rate cut back on the table. But we think ultimately the bigger push might be from the growth aspect. If we get a disappointment in some of the fiscal expenditure that we're expecting, then ultimately that could also push the ECB to cut. But that's currently not our base case. We're continuing to expect them to hold for the rest of the year.
OK, Rufaro, that's all we've got time for. Rufaro Chiriseri, always a pleasure to have you on the programme. That's the head of fixed income for UK and Europe at RBC Wealth Management. Thank you, Rufaro. Well, coming up on Daybreak Europe, the European Council President says that EU leaders are finally ready to unify capital markets to compete globally. We'll bring you more of our exclusive interview with Antonio Costa next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the European Council President says that the fracturing world order is driving the EU to act now on capital markets union. His remarks echo repeated calls from Europe's economic leaders in recent days, which have come with a dire warning that if the continent doesn't hasten these stalled reforms, it'll hasten its own demise. Well, speaking exclusively to Bloomberg, Antonio Costa said he hopes to lay down plans on Thursday during informal talks between EU leaders in Belgium.
My feeling is they are a real commitment for all the leaders and the clear sense of urgency of among all of them that now we need effectively to take decisions with impact in the coming times. And for sure, we need to continue to cut red tape. We need to move in the savings and investment union, because we need to ensure that we have a real European capital market to funding our companies, to funding innovations, to funding our companies to scale up and to be competitive in the global market. We need to look at our competition rules, because it's clear that we need to, at the same time, protect our consumers, to ensure a vibrant competition in our single market, but at the same time allow companies to scale up to be competitive in the global market. We need to tackle the issue of energy costs, and for this, of course, we need to do the right investments on renewable and low carbon energy sources to build the so-called energy highways. We need to invest more and more in strategic digital instruments like AI or quantum. We need to invest more and more in the innovation, because innovation is the main driver of competitiveness nowadays. Then we need to invest more, we need to invest better, we need to ensure security in our supply chains, we need to open new markets, and we need to complete and deepen our single market.
Now to some other top stories we're following this morning. Israeli Prime Minister Benjamin Netanyahu is set to meet US President Donald Trump later today. Netanyahu says he'll discuss Iran, Gaza and other regional issues with the US President during his visit to Washington. The US and Iran have so far struck a positive tone about the start of diplomatic talks. Speaking to a Senate panel, US Commerce Secretary Howard Lutnick has minimised his relationship with Jeffrey Epstein, while acknowledging visiting the disgraced financier at his private island in 2012 after Epstein was a convicted sex offender. 2012 was years later than Lutnick previously said that their relationship had ended.
We had lunch on the island. That is true, for an hour, and we left with all of my children, with my nannies and my wife, all together. We were on family vacation. We were not apart. To suggest there was anything untoward about that in 2012, I don't recall why we did it.
And at least 10 people are dead and 25 injured after a mass shooting in northern British Columbia. The shooting happened at Tumbler Ridge Secondary School yesterday afternoon. Police believe the suspected shooter died from a self-inflicted injury. The incident appears to rank as one of the deadliest mass shootings in Canadian history. Well, those are some of our top stories this morning. Coming up on Daybreak Europe, we're going to be speaking to Bettina Orlopp, the CEO of Commerzbank, as the German bank starts a share buyback after reporting full-year earnings that beat estimates. We'll be speaking to Bettina next. This is Bloomberg. Good morning from London. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Rising to a record. Asian stocks touch historic highs after weak US retail sales reinforce bets on Fed rate cuts. Traders closely watching for payroll revisions due later today. Back on track, EU lawmakers move closer to approving a US trade deal after it was put on pause over President Trump's Greenland threats. Plus, a bumper day for earnings in Europe ABN AMRO profit misses. Heineken sales give an early sign that the beer slump may be easing, while Commerzbank lifts its profit guidance. We'll be interviewing the German lender's CEO later this hour. Well, a very good morning. Welcome to Wednesday. If you're just joining us, it's 6:30 a.m. here in London. Unusually for a Wednesday, it's Jobs Day stateside. We already had the weaker than expected retail sales numbers yesterday. I'd show you the impact on the Treasuries market, but we're not having cash trading right now because it's a holiday in Japan. But what I can show you is the impact on gold and the dollar. So gold is higher, the dollar is weaker against its G10 peers because of this expectation that maybe we get 3 Fed cuts rather than just 2. So traders ramping up their bets on those off the back of these numbers. Will they do so more after the jobs numbers later on today? We've got Euro Stoxx 50 futures absolutely treading water right now, in contrast to the futures picture stateside, looking more positive on the other side of the Atlantic. And in Asia, we've got stocks already at a fresh record high. Well, let's turn over to the front pages this morning. The Times in the UK says that the investigation into the former UK ambassador to Washington, Peter Mandelson's links to the late paedophile financier Jeffrey Epstein are going to go all the way back to the Blair era. So civil servants trawling through records going back a quarter century for evidence of inappropriate contact between the two. Bloomberg points out, of course, that the UK Prime Minister never knew Epstein, and yet the Epstein files are threatening to bring him down, not the US president, who, of course, was once his buddy. But the Financial Times, meanwhile, is focusing on Starmer's travails here. They, of course, have been accentuated by the Mandelson-Epstein fiasco. And we have the FT reporting that the PM's allies admit he's too weak to sack the leadership rival Wes Streeting, the health secretary, of course, even if Number 10 suspects Streeting of being part of a coup attempt. So plenty going on in UK politics still. But finally, let's flip over to the Wall Street Journal. A corporate story on their front page after Bloomberg reported that an activist investor had built a stake in Warner Brothers. They've got the paper reporting that Ankara is pushing Warner to walk away from its deal to sell the movie and TV studios and HBO Max streaming service to Netflix. But you can get all these stories and everything you need to know to get your day going in today's edition of Daybreak, which, as ever, Terminal subscribers can find by going to DAYB Go. Well, let's get back to earnings, shall we? Commerzbank has lifted its guidance for profit this year, with net interest income now expected at around €8.5 billion. Joining me now to discuss is Commerzbank's CEO, Bettina Orlopp. Bettina, thank you so much for making time for us this morning. I flicked through these results last night, and they're looking pretty positive. What went right for you this quarter?
Well, I mean, the first quarter was a very strong quarter. So we had a record operating result in 2025 was €4.5 billion. This is the best result we ever had in the history of the bank, 18% plus in comparison to 2024. And it was mainly driven by 3 topics, not surprising ones: growth on the revenue side, very good cost discipline, and high asset quality. And that then leads also to a very attractive capital return of €2.7 billion in total, which we returned to our shareholders for 2025, including a very attractive dividend of €1.10, which is 70% up in comparison to 2024 dividend. And actually, the story continues because I have the benefit of already looking on the January number, and we had a very strong January.
And you've also lifted your guidance for profit this year. What are the main risks to that outlook?
Well, I mean, first of all, we concentrate on the tailwinds, and what we see is that we will see for the first time after 3 years, we expect growth for German GDP, so it's 0.9%, which is clearly helpful. We also assume that there will be, at least for Germany, a stable, or Europe, a stable interest rate environment, which is also supporting our case. This is also why we raised our outlook for NII to €8.5 billion. Then we strongly believe in our power to increase our net commission income by, again, 7%, and then combined with strong loan growth and a good cost discipline, that leads us to the raised outlook, with also a much improved cost-income ratio of 54%.
Bettina, can you put a number on how much that German fiscal stimulus is going to boost Commerzbank this year? Because the Deutsche CFO was a little more hesitant. They think that it's going to take a bit longer to really feel the impact on their bank.
Well, I can only look on the 2025 numbers, where we basically have not seen any growth for Germany, and still we reported a loan growth of 10%. So we are kind of not completely independent, for sure, but we're kind of independent. But because what we do is, specifically when it comes to investments of our corporate clients, we are at their side wherever they go. So either they invest in Germany or they invest abroad, which we have seen in 2025, and we are part of it. But clearly, the 0.9% will also help our growth.
You mentioned the buyback. These payouts, clearly part of your defence against that unsolicited approach from UniCredit. I wonder when your last contact was with Andrea Orcel and what exactly he's told you about his intentions.
Well, I mean, UniCredit is a large shareholder with 26%. So we do very regular investor meetings with the bank as an investor. They are very normal investor talks. They happen every quarter. They will also happen this quarter, which is normal with large investors. We also do that with other ones. And there are normal investor talks. I think the only thing which is different to all other investor talks is that we do not talk about the UniCredit situation.
And turning to the geopolitical backdrop, Bettina, with President Trump destabilising the world economy, are you witnessing a change in supply chains and trade routes that's impacting your bank?
I mean, what you see is that corporates are thinking a lot about where to invest, how to localize certain things, how to deal with the tariff situations, how to increase flexibility. I think it's also important that Europe is doing what they're currently doing, having as many trade agreements in place as possible. So India was important, Mercosur is important, and it is now the most important part is to focus on Europe, and therefore the meeting tomorrow will be also very important.
Yes, indeed. We've been discussing that this programme. But also we have loan loss provisions rising, big bankruptcies hitting the highest rate since COVID in the US. How do you expect risk provisioning to develop going forward?
I mean, our asset quality has proven to be very, very good. Corporates have been very resilient, private clients anyhow, because unemployment rate is still very low. If you look on our NPE ratio, it's still at a very low level of 1.1%. And you also see it in our risk result, which even come in lower for 2025 than for 2024. We stay cautious on 2026, so we keep it up at 850 million, at least the guidance. But the truth is that our loan portfolio is so diversified that we can cope with it pretty good. And if you also look on the increasing number of insolvencies, which we have seen in Germany, but also, first of all, the growth has come to certain type of pause, but it's also specifically very small corporates, very, very young companies who are falling in the category of defaults. And that is clearly less of a burden than if you see large insolvencies.
There's also renewed talk in Brussels about simplifying bank rules. There's been commentary from Deutsche Bank saying that it'd be quite surprised if FRTB is implemented as planned. Do you share that view?
Well, FRTB is, for us, less an issue. We are, I mean, it's also important for us, but more important is what happens to the transition rules when it comes to the output floor or when it comes to unrated corporates. And we also clearly advocate to rethink that given the developments in the UK, but also in the US when it comes to regulation. So we are clearly a strong supporter, not only to think about simplification, but also deregulation to a certain extent.
We also got to talk about AI, Bettina. I feel like there's never a day on this show when we're not talking about a sector that's being hit by artificial intelligence. Anthropic just releasing a model that's highly capable in financial research. How does that change your thinking about Commerzbank's own research unit? Is it going to become obsolete?
But first of all, we already use AI tools in our research department to predict certain things, to create reports. So we use them as a tool. I see AI really as an opportunity for us, for our bank. It is one of the key priorities for 2026. We laid some very good foundations in 2025. We have basically use cases in every area of the bank, and now it's really the time to scale it up, to figure out what the whole governance is around it, what it means for our people's strategy, what it means for our clients, and how we really transform our processes with AI. And for us, it is really important, and it will help us in improving customer experience, but also improving efficiency.
So are the benefits of AI already outweighing the costs?
Well, in the moment, we are in this exploring phase as many others, and we have some very good use cases already in place. For example, we have an agent assist, which we use in our customer center to serve clients when they call us, and it's an automatic transcription, it's an automatic summary of the meeting and of the call, and then also developing automatic solutions for the client, which is very helpful. We also use it, and there we definitely see that the benefits are more than the cost on our fraud side, because we have a self-developed AI tool for fraud detection, and we use that already, and it has proven to be very efficient.
OK. Bettina, really appreciate you taking the time to walk us through those results this morning.
Thank you very much.
That's Bettina Orlopp, CEO of Commerzbank. Well, I just want to bring you more of these earnings. It's a bit early for beer, but I'm going back to Heineken because we did talk about their total volumes. I just want to give you the correct figure here. Their total volumes fell 1.2% in 2025. So the brewer, of course, makes Amstel beer. It's got this pullback in beer consumption in critical markets, the likes of the US and Europe, because consumers are moderating their alcohol consumption. So 1.2% was the decline in total volumes for Heineken. They're also cutting up to 6,000 jobs amid this slump. So interesting to note that, and we'll keep an eye on those shares at the open. But it is a busy day for earnings. Coming up right here on Daybreak Europe, we're going to be speaking to Jolanda Poots-Bijl, the CFO of Ahold Delhaize, about the Dutch retailer's fourth quarter earnings. So more from the Netherlands next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. A busy day for earnings. It's 6:45 a.m. here in London. We've already had numbers from Ahold Delhaize, and they're looking at 2026 adjusted operating margin of about 4%. So pretty much in line with the estimate of 3.97%. And for fourth quarter adjusted operating margin, they come in at 4.2%. The estimate was for 3.93%, so a little bit of a beat there. But let's dive into these numbers now, shall we? We have the CFO, Jolanda Poots-Bijl, joining us now from the Netherlands. Good morning to you. Thank you for making time.
Good morning,
I want to start with the
yes.
margins, because there needs to be a balance, right, between price hikes and the need to stay competitive. How are you striking that?
It's an important question because we're here to support our customers, to stretch every cent every day. So that balance is something that we work on every day. If I look at the quarter and the year as a whole, in that quarter and also in the year of the whole, we see that the world moves quickly. And in that dynamic context, we're delivering consistent results. And strong results, whilst we're also investing in our prices and expanding our own branded assortments. And those investments in prices, we announced them when we started our Growing Together strategy, $1 billion in the US alone in 4 years' time. We're on track to deliver on that. And we're also expanding our own branded assortment, which it means for a customer, high-quality products at lower prices. So all in all, Lizzie, I'm quite happy with the results we delivered in that first year of our Growing Together strategy, exactly balancing that margin growth, serving our customers. And we're also well positioned to continue doing that in 2026. So thank you for that question.
Well, I know that Stop & Shop's had to present a better value image. Is that a process that's complete now, or are you going to have to go a bit further when it comes to price investment?
The thing about our industry, about groceries, it doesn't move fast, and there are many details that need to come together on a daily basis. So if you look at Stop and Shop, where we indeed have a transformation plan ongoing, it's not fixed in 1 year, but I do see some very promising results. Our Net Promoter Score is increasing massively. It's on an all-time high. We are investing in our Stop and Shop brand substantially, and we're at 67% of our stores now being invested, and customers respond very favorable to that. But we're also investing in our service levels, in the assortment, so many other things to drive that success. And I would call it also in that perspective a good start for that Stop and Shop transformation on track.
Jolanda, a big theme of this earnings season has, of course, been dollar weakness. How much has it impacted your business? And if it persists, how much could it impact your business going forward in 2026?
Yeah, it of course has an impact as we present our results on a euro basis. For a margin perspective, it doesn't impact, of course. If I look at it, our business is 65% in the US. It's local business. So our underlying business results do not change because of that weakening dollar directly. So it's a translation result at large. And thus far, I think we've coped well with it.
And inflation's slowing. So what levers do you have to keep sales growth higher?
Yeah, our Growing Together strategy, the word in itself already says it, we're focused on growth. And I always say also to our associates, it's not growth in itself that we strive for. We need that growth to create skill, to keep our prices low for our customers, and to create the dollars and euros we need to invest in tech, AI, but also in our sustainability commitments going forward. So growth is an important theme, and how we strive for growth is just improving our customer value proposition in many aspects. And like I said, those price investments needed to support our customers will also drive volumes. And if I look at the volumes, for example, in the US market, in 2025, we had positive volumes close to 1% in a market that had negative volumes. So I think that strategy is paying off, and we're on the right track. Again, it's the first year, and the new year already started, and we have to fight every day to improve every day. But focusing on that customer value proposition, putting our customer in the center of our strategy, and focusing on delivering those results, creating skills, lowering prices again, drives up those volumes. So I would like to improve on that volume level also going forward even further. But positive volumes both in the US and in Europe in 2025 was not a bad result.
Jolanda, it's great to have you on the programme. Thank you so much for walking us through those results and your outlook. That's Jolanda Poots-Bijl, the Ahold Delhaize CFO. Thank you so much. Well, now to some corporate news. Paramount has sweetened its offer for Warner Brothers, addressing some of the company's concerns in an effort to thwart a rival deal with Netflix. Paramount will cover the $2.8 billion termination fee that Warner Brothers would have to pay Netflix if it ends the already agreed-upon deal. Warner Brothers says it'll review the amended offer. Elsewhere, two of the co-founders of Elon Musk's artificial intelligence startup XAI are leaving the company after less than 3 years. With the departure of Jimmy Barr and Tony Wu, it means half of the company's founding members have now departed. Those departures follow XAI's recent merger with SpaceX. And Bitcoin has drawn fresh support from some of its largest holders, though the return of demand remains narrow enough to raise doubts about whether it marks a recovery or just damage control. So-called whale wallets accumulated about 53,000 coins in the past week, their biggest buying spree since November. Bitcoin is roughly 40% below its October peak, as you can see there. Plenty more coming up on the programme. Don't go anywhere. This is Bloomberg.
Rather than trying to fine-tune the funds rate, I'd prefer to err on the side of patience as we assess the impact of recent rate reductions and monitor how the economy performs. Based on my forecast, we could be on hold for quite some time.
Cleveland Fed President Beth Hammack there. She was already critical of the last of the Fed's 3 rate cuts last year, and there's even more data to pass today. The jobs report coming. But first of all, let's look at what we got yesterday. US retail sales flatlining. The estimate was for 0.4%. Actually, they came in surprisingly weak at 0%. So that flatlining underscoring this difference between how consumers are faring with, for example, the Ferrari and Gucci earnings actually doing pretty well. So flip the board over, we can take a look under the hood at this. The difference between consumer and discretionary spending. So blue is discretionary, white here is staples. And if you're buying more of what you need than what you want, then it's not a good look, is it? This is what we can see here. Let's take a look at the market impact. We haven't been able to see what's going on in Treasuries this morning because, of course, there's no cash trading in Treasuries because it's a holiday in Japan. But this was the impact on the 10-year yesterday, taking it to its lowest in a month because this data has amped up bets on Fed cuts. Now, it's not just the 2 that are fully priced. Traders looking at maybe a 3rd Fed cut this year in addition. Is the jobs data later on going to add to those Fed cut bets? Let's take a look at the risk events on the docket, because those jobs numbers are coming at 1:30 p.m. London time. The expectation among economists is for 65k. The whisper number last time I checked was 36k. Is this and the CPI data on Friday going to add to those Fed cut bets, we ask? We'll get a view from Mickey Bowman at the Fed at 3:15 London time. And, of course, we keep an eye on oil. We have the OPEC market report coming out as well today. The API report suggesting swelling inventories. But for the moment, traders more focused on the geopolitics, the ramping up of tensions between the US and Iran. That is the focus for oil traders at the moment this morning. Plenty to discuss on the opening trade. Anna, Guy and Tom will take you all the way to the European cash open. Stay with us. This is Bloomberg. Good morning.